Welcome to the Jay Martin Show. My guest today is Ronald Stöferle, the author of In Gold We Trust, with over 2 million readers. Bananas, amazing work, Ronnie. He puts out an annual report that's about 400 pages long, covering anything that impacts the gold market, in addition to managing about 6 funds. He's a very busy guy. This is an epic conversation. I hope you enjoy it. As always, in the YouTube description, there is a link where you can subscribe to my weekly newsletter. I absolutely love writing it, and it's free. I publish every Sunday. I'd love to have you join the team. Here's Ronnie. Enjoy.
This is Jay Martin.
All right, welcome back to the Jay Martin Show, and I'm joined right now by Ronald Stöferle, the author of In Gold We Trust. Ronnie, it's good to see you again.
Hey, Jay, how are you?
I'm really good. And I'm looking forward to getting some perspective. Are you in Vienna right now?
Yeah, currently in Vienna.
Perfect. Okay. Yeah, I'm looking forward to getting some perspective from the street in Europe, because we're seeing all kinds of headlines in Canada and the US about what's occurring from a sentiment standpoint, specifically about concerns about the winter and the incoming energy crisis and how real this could get. And I'm always wondering, when I see these headlines about civil unrest and protesting, what's really happening on the ground. So maybe you could share, we could start there if that's all right.
Well, where should I start? I think regarding the sentiment, Europeans tend to be a little more relaxed when it comes to work compared to North Americans. So the as the Italians say, the dolce far niente, so the basically doing nothing and enjoying yourself. That was happening over summer. So everybody was trying to make the best out of it. We're coming out of 2.5 crazy years due to COVID. Everybody said, well, let's screw what's going on over there with Russia and the Ukraine, with inflation and stuff, and just spend a really nice summer. But now I think people are coming back to their offices. And they're coming back to just thinking more about fall and winter and actually the economic consequences that we're seeing coming from energy markets. And I have to say that I'm actually pretty terrified. I'm pretty concerned. I'm very bearish when I see what's currently going on. And I think we can talk about the energy situation, obviously, but I just tweeted out, probably the most important price to follow at the moment is the US dollar, and the Dixie, which is obviously very much euro heavy, or euro light, increasingly. It's now trading at 110, and it acts like a big wrecking ball for capital markets, for emerging markets, and especially for the Eurozone at the moment. So this, in combination with quantitative tightening that is being ramped up in September, and a very hawkish Federal Reserve, I think that's really the recipe for a quite volatile and I would say pretty challenging, to be diplomatic, fall and winter season in financial markets. And over here, in Europe, well, we are engaging in an economic war with Russia, which is obviously, it is the trigger, but it is not the root cause of the whole energy crisis that we're facing at the moment. So there, it's easy to blame Putin for all the troubles that we're in. But actually, I think our strategic decisions when it comes to energy infrastructure have been very, very poor, and now we're we gotta pay the bills for that.
Now, how is the public responding to that? Because the way you phrase it, Putin was just the trigger point, but there maybe could have been another trigger point. Europe was already in a vulnerable energy position. And so is the public recognizing that? And is there any unrest in response to the position that Europe's put itself in regards to energy reliance?
Well, there is a response, and I would say that well, first of all, we're seeing not riots on the street yet, but demonstrations. We're seeing that the whole sentiment is shifting more and more into a direction. Well, actually, uh, we're not really affected by this war at all, but we are heavily affected by the economic consequences. What we are facing is not a recession; it's rather a depression, and it's a depression combined with very high inflation, and inflation that is much more sticky than all the economists tell us. And one reason for that, obviously, is the weakness of the euro. So so I think going forward, when people realize, well, actually my utility bill, my electricity bill, my natural gas is up not like 10% or 50%, 15%, but rather 3 or 5 times. Um, there's I don't know what people will actually do. Obviously, many businesses will go bankrupt. So far, the solution, for example, over here in Europe, over here in Austria, but also in Germany, well, first of all, they try to cap prices, so heavy subsidies for consumers, not so much for industrial companies yet. But I think going forward, um, let's take a step back, Jay. I would say that through the COVID crisis in Europe, we all got very much accustomed to the fact that actually the government takes care of everything. I know so many business owners, restaurant owners, for example. They actually got 80% of their turnover back from the government. So
Mhm.
actually, in 2021, um, most of the restaurants, but also hotels and so on, they had their best year ever without having to work, because it was not tied to profitability, um, to other measures, but just to the turnover of the previous year.
Mm.
So we all kind of got accustomed to this nanny state, and now we all think, well, energy prices are up, but our governments, our politicians will take care of that, and we'll just, we'll get through that. Um, of course, at some point, markets, and especially the bond markets, will become very nervous. We're already seeing that, the 10-year bonds in Germany, they're now at 1.5%. They have been in negative territory for many years. The spreads, so for example, Italy versus Germany, they're rising significantly. So I expect at some point. So let's say my roadmap going forward is, politicians will try to cap prices, will try to subsidize everything. Then we'll see increasing pressure from bond markets. And then I think the ECB will try to implement some sort of yield curve control, which will add further inflationary pressure, which will add further pressure on the euro. So I can easily see the euro trading at zero point 0.8 to the US dollar in 1 or 2 years from now. So it's a very complex development at the moment, and as I've said previously, I'm not very bullish, and with every day, the numbers coming in, I'm increasingly turning bearish, because it's obviously the crisis. I would say the majority of the problems is clearly in Europe. The US, on a relative basis, I would say the Federal Reserve did a much better job, and it seems that the US economy is much more resilient. Obviously, we're heading into a recession in the US, but it's also China with the zero COVID policy that is not doing so well. And we're seeing the consequences of the strength of the US dollar in so many emerging markets now. We're seeing it in Sri Lanka, we're seeing it in Lebanon, we're seeing it in Egypt increasingly. So it's a very, very complex setup that we're currently.
What's up, guys? Jay Martin here, host of The Jay Martin Show, with a quick announcement. This Thursday, September 22nd, right here on the YouTube channel, we're going to be hosting the Silver Briefing, diving deep into the silver sector. And I'm going to be joined by a handful of rockstar guests like David Morgan, the founder of the Morgan Report, Jeff Clark, an editor at goldsilver.com, and Lynette Zhang, a currency specialist and the founder of ITM Trading. And we're going deep into the silver sector on Thursday, September 22nd at 1 p.m. Pacific time. I'll also have a couple surprise guests. You're just going to have to wait and find out who they're going to be. I'll be active in the live chat. Love to see you there on Thursday, September 22nd, 1 p.m. Pacific time for the Silver Briefing. All right. No doubt. And you're right. The US dollar's fared remarkably better. A lot of the public sentiment issues that you described, I think, are still ever present here in North America, being the nanny state mindset. Absolutely. I see that everywhere. You know, it's interesting to hear your perspective, because I've seen a lot of like social eruptions coming out of Europe in the last maybe just 2 weeks, right? There's a site now live called don'tpay.uk, where over 220,000 people as of last time I looked, but they're shooting for 1 million people as of October 1st who pledged not to pay their utility bill in some kind of mass protest. There's a bit of a less organized protest in Naples, Italy, where a bunch of people just gathered in the streets to light their utility bill on fire. And I know there was 70,000 people that took to the streets in Prague last weekend, right? I think really it sounded like to protest the stance the Czech government was taking on the war. And they said, we need to take our hands off this conflict in exchange for cheap energy from Russia. So, you know, I'm very curious how that will evolve over the winter. And, you know, new leadership in the UK, I'm very curious about that. Liz Truss has sort of presented herself historically as a libertarian, and I don't know if you would qualify her as one. And I think her first move will be a massive government handout of some kind. So it's contradictory to their reputation. But what are your thoughts on that? Because you're laughing, Ronnie. What do you think?
Well, I don't think that she would qualify as a real libertarian. I mean, she's often compared to Maggie Thatcher, but I think, you know, that's she's still very far away from that. And I mean, we'll see. To be honest, Jay, being a politician these days, but also a central banker, that's kind of a lose-lose situation. I don't see any leadership in particular that would make me a little bit more relaxed. Not in the United States, not in Canada, not anywhere in Europe. We'll see. I mean, I think what's really, when it comes to this great divide and this loss of trust that we're seeing, I think, you know, this has already started earlier, and we're seeing this great, how do you say, bifurcation, this great divide. We saw that already with the COVID crisis. You know, everybody became an expert on virology and stuff, and you know, everybody had a very, very strong opinion. We're seeing similar developments when it comes to trust, or loss of trust, loss of confidence in the media. We're seeing similar things, obviously, with institutions, with financial institutions, with the banking industry, with money itself. And obviously, I think that, you know, this loss of trust is now already is also being seen when it comes to the whole energy crisis. And to be honest, I think this is a perfect example of a black swan. I think nobody really would have expected that this could be, you know, the needle that pops this everything bubble that we've experienced over the last couple of years. And we could also say that perhaps we will now realize that perhaps energy was just too cheap over the last couple of years. That food perhaps was too cheap. Perhaps it should gain in importance. Perhaps we will have to adjust our spending behavior and not order crap on Amazon every day and go out eating every day, but rather stay home and cook your own meals, whatever. So I think um, in German we say den Gürtel enger schnallen, which is basically tightening the belt. It necessarily doesn't have to be a bad thing. I think this could also be a positive thing over the longer term. But obviously, it will cause a recession. It will cause a massive recession, and we're already. I mean, I'm just I just cannot believe that so many economists out there still see a soft landing. That they're trying to discuss, is this a technical recession or is it a real recession? From my point of view, I mean, a recession is we already in a recession, and the big question is only is it going to be a recession or a depression? And this, in combination with inflation being much more sticky than most people think, that's a pretty nasty setup for financial markets, obviously. And um, I mean, this year alone, Jay, in equities, in U.S. equities, no, I think that's worldwide. 21 trillion of market cap were wiped out. For global bonds, it's 16 trillion. And then add on top, the losses in crypto markets, in commodity markets. I mean, have a look at commodity prices since April and May. It doesn't look very inflationary, actually.
No.
I think most of the commodities are pricing in a massive recession. Real estate, private equity will follow next. So actually this reverse wealth effect that Bill Dudley was referring to. So basically, trying to pop the bubbles in financial markets, and by that, reducing demand and causing a soft landing. We'll see where it goes to, but so far, I'm just seeing that CDS, for example, for many banks, just have a look at the credit default swaps for Credit Suisse, for example, at the moment. They're exploding, and I think over the next couple of weeks we will see. I mean, that's kind of a that's not a big call, but I'm pretty sure that volatility will spike up. I'm pretty sure that at some point the pivot will happen. But if we compare the current setup to 2018, when Jay Powell made his last big U-turn, basically he reversed its course over 6 weeks because the stock market collapsed. Well, back then CPI was below 2%. And now at the moment it's above 8%. So he cannot really do the quick pivot, and I think this is really what people should prepare for. I think we are all conditioned like Pavlovian dogs, that every time it's getting a little bit tougher in financial markets, the Fed will jump in. But this time they're just not able, because inflation is still way too high. So what I could see, and this is really as a trader friend of mine, he always says the market is a maximizer of pain. I think the most painful environment going forward would be a very, very nasty sideways market, with bear market rallies and then crashing markets again, a market where you really have to be very, very active, where you have to trade those little bear market rallies and then get out of the market. And I think it's interesting, because one of the big trends beside ESG, which also, from my point of view, is responsible for many of the troubles that we're having in energy markets. But the second big trend in financial markets was clearly passive investing. Everybody said, I'll just buy a tracker, I'll just buy the ETF, and of course, if markets are just rising all the time, that's pretty fine. But I think the setup for the next couple of quarters, probably years, will be a setup for very active asset managers. So this is kind of my roadmap going forward.
Interesting. So much of what you said makes me think that we're returning to almost like a more practical world, right? Like there's been a bit of a breakup of trust, both at like the local public level and at the global level. Like, our addiction to cheap goods and services, as you mentioned, like that's in response to global trust being really high, right? China can trust the US, can trust Russia, can trust Europe, and this exchange of cheap goods, cheap energy and US currency to fund it all exists. But as soon as that trust breaks up, the whole system shuts down, we deglobalize and get back to maybe like, I want to call it a place of normalcy where we're paying real value, accurate value for the goods we need. And so when you hear sentiment like soft landing coming out from politicians and the Fed, and I just assume it's just about public control, right? We don't want people to freak out. So we're going to depress the inflation numbers. We're going to promote as much as we can. This will be a soft landing or a short recession or whatever. They just, and that's very typical. We saw that in 2008 during the tech wreck in 2000, that it's not going to be as bad as it is. And then every time it gets a little bit worse, we'll just tell people that's about as bad as it's going to get, right? And then it'll get a little bit worse. So that's about as bad as it's going to get, right? And so how much of that narrative coming out of our political leaders and the Fed is just about controlling emotion and controlling the reactivity of the public?
Mm-hmm. Well, yeah. I mean, I agree. I've never heard an economist or a politician basically forecasting a hard landing or a nasty recession.
Right, of course. Yeah.
Definitely. And I think most of the trends that we're seeing, so this kind of deglobalization, and also this loss of trust between nations, and obviously was what happened this year. It clearly means that Russia will continue to be a pariah state for many years to come. So I think it's really a big shift, a big break in international relations. But we're also seeing that countries are acting differently, while over here in Europe, we try everything to, our politicians try everything to win this war, to rearm, support the Ukraine. On the other hand, other nations are playing more of a realpolitik game. Yeah, so like China, India, but also Saudi Arabia. I mean, the number of deals that were sealed over the last couple of months, it's just staggering. Yep. And it just tells me, well, actually, there's morals and there's the, let's say, the ethical side. But then on the other hand, you also have to feed your people. You also have to heat the homes and to keep everything running. And I think at some point, over here in Europe at least, they will realize that they will have to go back to the negotiation table. But it is like if you have a fight with somebody where both sides basically feel, well, this isn't going anywhere, but then both sides are just too proud and they've got, nobody wants to make the first step. And as I'm reading it at the moment, I think that the European Union won't make the first step, and I don't think that Putin will make the first step. So actually, I have to say that Russia is playing this pretty well. It's not a coincidence that many of the best chess players are from Russia, and it seems to me that there are always one or two steps in front of us. So I mean, what does it actually mean for us over here? We have to rearm to defend. I mean, Germany basically outside they outsourced the military, they outsourced their energy, they outsourced their technology also to some degree. But now they are realizing that they have to rearm. We have to reshore. So we have to get around all those blockades, which is a very, very I mean, it's easy for a politician to say, well, we have to produce the stuff now on our own soil, but it's just not that easy. I mean, in Finland, for example, it took them, I think, 18 years to build a nuclear power plant. Probably primarily because you just don't get the people. That's really human resources is probably the main bottleneck that we are facing. But then also we have to restock. We have to invest in the commodity space, which is also something that's very, very slowly being realized. But there as well, we don't have the infrastructure, we don't have the people, we don't have the capabilities at the moment. So this will take time. And for this energy transition that is currently going on, we have to rewire the whole grid, which will cost not billions but trillions. So it is really a very, very complex setup that we're having over here. And I need, as a business owner and as a family father, I would like to be a bit less gloomy, but at the moment I'm just very, very, very concerned, I have to say.
Well, that's not a bad mindset to keep. It's, sort of protective, right?
Yeah.
And wary, and therefore I think a bit cynical. And that can assist. I mean, it's probably better than being blindly optimistic, which a lot of investors have been for the last decade. Now let's pivot to gold a little bit, Ronnie. And I'm not so concerned about like the near-term performance. I don't sweat that stuff because my time horizon is never 3 months. It's just not, right? I'm typically multi-year. What catalysts do you see? So gold's been sleepy, and it's made a lot of people curious as to why every macro signal that usually points to a strong gold market is occurring, right? There's crazy inflation, there's geopolitical unrest, civil unrest, the currency war is occurring, but gold's been flat, right? Relative to US dollars. And that's important, right? I think that's more of a US dollar story than a gold story, but I'd love to get your thoughts on that. But thinking longer term, right? What catalysts do you see, whether a country like Russia proposing reintroducing gold as a settlement asset for its energy? Are there any big trends or big trigger points like that could reinvigorate and reinvent the gold market over the next decade or two?
Well, regarding the performance, let's first say, I would be a liar if I would tell you, well, this is exactly what I always forecasted. I'm definitely disappointed. I'm not concerned. I mean, it is, as you rightly said, it is primarily a dollar story at the moment. For us over here in the Eurozone, gold is up 9% year to date, which basically says, well, it protected your purchasing power. In Japanese yen terms, gold is up 15%. I think in general, what's going on in Japan at the moment with their yield curve control, trying to protect the 25 basis points for the 10-year JGBs. That's really the monetary end game, I would say, that is going on in Japan. So I think gold did an okay job, but obviously, as I've said before, the strength in the dollar, that's just something that did hurt the price quite a lot. Well, I think sentiment-wise and commitment of traders report are suggesting that we could be somewhere close to the bottom. We're seeing seasonality in September is actually really, really good. I think we could test 1680 and even go lower. But I think, with on a relative basis, if I have a look at equity markets, if I have a look at the bond market, that is basically posting its the U.S. bond market, it's posting its weakest performance, I think, since 17 something, as Jim Bianco noted. I think gold held up quite okay. Now going forward, I think first of all, we are seeing that the world needs some sort of a neutral reserve currency if we're really being divided into at least two blocks, which is, let's say, the Western world, and then the emerging markets world. That is, we have to say, that is showing a pretty strong balance sheet compared to many other Western nations, that is having, I would say, healthier demographics, and that owns and produces quite a lot of the very important commodities. So all the things that we are seeing from the most recent BRICS summit, for example, it's clearly showing, well, perhaps they've got more leverage than we have. So I think sometimes we're kind of overestimating our hands that we're holding. What I thought was really interesting, we saw, for example, coming out of Russia, we all know that they bought enormous amounts of gold over the last couple of years. We know that they're a significant gold producer. They're the third largest gold producer. But we also saw, for example, that they now introduced this Moscow World Standard, which should be basically some sort of an alternative to the LBMA standard, I would say. So I think those little signs that suggest, also with, for example, Dubai introducing a new trading standard, and then there was Nigeria coming out. I think Nigeria is the 9th largest oil producer. They're coming up with a gold exchange now. I think those are already small signs that gold isn't a petrock and something that is actually useless in these modern times, but something that is valued in countries, especially in the Eurasian Economic Union, that is very, very important, in the BRICS nations, in Africa, and therefore I would say that over the longer term, I mean, I'm super relaxed regarding gold, and I think as soon, and that's really the financial market player perspective, I think as soon as the Federal Reserve kind of signals that they will step on the brake, and that they will have to pivot, and that they will have to stop their QT, I think gold, silver, the miners, and risk in general, probably also cryptos and so on, will take off. But for the time being, I would say that the world needs a neutral, a liquid, and globally accepted currency that is valued in both blocks, and I really don't hope that we are going into this direction again, but news and developments from the last couple of months clearly suggest that the world has now really split up into at least two different blocks.
Now, when you see initiatives from Moscow or Nigeria getting back to some kind of a gold exchange, is there the possibility that begins to undermine the paper gold market?
Yeah, definitely. I mean, we all know that on paper markets, I think every physical ounce of gold is traded 140 times.
Right.
So I always said, I started writing about gold 15 years ago, and I keep hearing the same stories over and over, and I just always said, well, of course, I mean, there's manipulation or intervention happening in the precious metals market, and we've got lots of evidence for that. Um, but obviously, it's also happening in bond markets. It's happening in, I mean, the fact that a committee basically sets interest rates. That's the most important price in capital markets. That's a huge manipulation. So I think it's sometimes a bit of an excuse for investors sitting on big losses to say, well, it is manipulated. So if you think it's manipulated, then just buy the physical stuff. Don't buy ETFs. Yeah, don't buy any certificates, whatever. And just relax. But if you want to have, and that's the differentiation that is really important. What's your motivation for buying or holding gold? Do you want to have a hedge against financial catastrophe, hyperinflation, monetary reform, or do you want to make a performance?
Mm-hmm.
And both is legitimate. But if you want to make performance, obviously you can buy derivatives, you can buy mining equities, whatever. But don't mix it up. I think that's really important to understand.
Yeah, that's understanding your why
Yeah,
behind owning an asset.
exactly.
Hyper,
Yeah,
hyper important. Helps you define your
yeah.
time horizon, your risk tolerance, all that stuff. Where is your cash right now, Ronnie? Talk to me about your portfolio, and where have you hedged? Where have you got well stored right now? Where are you safe? I mean, back to your gold analogy, if you're looking to protect against crisis and inflation, there's one reason. If you're looking for upside, there's another reason. Maybe look at the equities. What's safe for you, and what's your upside right now?
Well, Jay, we are managing 6 investment funds, and we do have a wealth management department for high net worth individuals, primarily from German-speaking countries. We've got together with my partner Mark Walek, we manage 3 funds. Two of them actually combine physical gold with Bitcoin with an options overlay, where obviously Bitcoin is suffering big time at the moment, but we actually we harvest the volatility of Bitcoin by the options market, which is pretty interesting at these price levels. And then in our inflation fund, for example, we over the summer we put in stink bits in high quality gold miners. We also used the options market. We wrote quite a lot of options. So actually, we've got a pretty high allocation in the gold mining space at the moment, which was tough over the last couple of days, I have to say. Um, but we were doing really well on the short side, especially shorting the BTP, which is Italian bonds. We're short the German DAX, so this helped clearly, and I think we will also. And this is not, that's not a marriage that we're considering. It's more like a short affair, or a trade, I would say. I think in the bond markets, especially, for the 30 years and so on, I think if this disinflationary pressure that we're seeing, or that we're forecasting, really materializes, then I think we could expect some really nice moves in the bond market in US Treasuries. So especially really the 30s. So you can also do the TLT, for example, which is the long bond ETF. But as I've said, that's more of a trade. And then I would say, we're shorting JGBs, which doesn't really cost anything at the moment, and it's a very asymmetrical trade. And I would say for the miners, I mean, obviously, the technical picture looks pretty damaged, I would say. Yeah, I mean, the HUY is trading at 180, for example, at the moment. We were trading at 320, I think, in spring. But if we have a look at balance sheets of most of the companies, I'm really seeing deep value in many mining companies, and gold miners, they have rarely, if ever, traded below 5 times price to cash flow, and they haven't traded there over the last 15 years.
Mm.
So I would say for the medium term, if this pivot takes place at some point, I think that's a great setup. Um, I told you before, I'm heading over to the United States for the Precious Metal Summit and Denver Gold. I think I've got like 80 meetings set up. I'm really looking forward, because many companies that we're following, that we've got on our watch list, are trading at ridiculous price levels at the moment.
Mhm.
And it is probably one of the most contrarian setups that I'm seeing now in the mining space. And a trader friend of mine, he always says, when you take a big and bold position, it has to hurt. It has to give you, second thoughts. It has to make you uneasy, because if it's easy, and if everybody says, well, that's a great idea, Ronnie, you gotta do that, fantastic, then you should probably be a little bit more cautious. So I think the mining space at the moment, fortunes are being prepared in bear markets, and I just see that there's lots of great companies out there. Balance sheets are fantastic. Obviously, they're feeling the cost inflation on many ends, but I think that's a really good setup that I like at the moment, because um, from my point of view, over the short term, I think the market is kind of overestimating inflation. So our proprietary inflation signal shows disinflation, but I think the market will continually underprice inflation risk over the next couple of years. So that's kind of my game plan.
Fascinating. Okay, Ronnie, look, I appreciate your time. Thanks so much for coming on. And where can I point people? They want to hear more from you, learn more about incrementum, the In Gold We Trust report. Where should we send them?
Well, yeah, I mean, I'm managing partner at Incrementum, which is based in Liechtenstein. We're managing 6 investment funds. The webpage is incrementum.li. We do publish the In Gold We Trust report, roughly 400 pages about gold, inflation, mining equities, but also the history of money, the future of money. You can download it totally for free on our webpage, ingoldwetrust.report, in German, English, Spanish, and also in Mandarin. We do publish the monthly Gold Compass, which is a monthly chart book on gold, miners, inflation, macro. We just put it out recently. And you can download it as well, totally for free, without having to subscribe, at ingoldwetrust.report. And then I'm also pretty active on Twitter. My handle is at Ron Stöferle. So I'm posting quite a lot of charts, but also private stuff, from, practicing and running and stuff. So yeah,
Love it.
that's basically it.
And can you give me a sense of the number of downloads the In Gold We Trust report got this year?
Yeah, we have 2 million readers, so it is really big.
Amazing. It's amazing.
It was quoted in 80 countries, so really a global presence, and we're already working on the next edition. So
Yeah. Well, the scale of it, I mean, 400 pages, right? It's a ton
yeah,
of work.
it
Yeah.
is. It
Yeah.
is. It is. But we're getting tremendous feedback from all over the globe, and that's a great motivation. And I think, just as a final sentence, I think when it comes to gold, there's lots of gloom and doom, everything will go to hell kind of research out there. We just want to make the solid case, especially also for institutional investors, for professionals, why you should own at least some gold in your portfolio, how it works, how gold stabilizes your portfolio in stagflation, for example. That was the topic of this year's report. So that's really what we're aiming for.
I love it. Love it. And congratulations on those numbers, Ronnie. That's huge.
Thank you very much.
2 million readers. Phenomenal. Okay. Thanks again. I appreciate your time.
Jay, thank you very much. All the best. Talk soon.
All right, thank you for watching this interview. Now, 3 things before I let you go. Number 1, I publish a weekly newsletter and I love writing it. I share my biggest takeaways and action items from the conversations that I have on this channel. In addition, my thoughts on current events, economic events, political events, and you can subscribe for free. Just hit the pinned comment right beneath this video, or just go to jmartin.club and you can subscribe on the website. I'd love to have you join the team. Number 2, ad revenue from this channel is donated to an organization that is super close to my heart called Zero Ceiling. Now, Zero Ceiling's mission is to end youth homelessness, and the way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness areas and then provide them with supportive housing, career training, and just generally positive influences on their life. I love what they do. Check them out if you're interested. And number 3, if you prefer to listen to my content as opposed to watch it, you can find me wherever you listen to your podcasts. Just search for The Jay Martin Show. All right, thanks again.